Life insurance is a very big topic, and it's a very unknown topic for a lot of people. And there's a lot of salesmen coming in people's inboxes and coming in people's financial pictures and trying to sell you life insurance, right? You have to step back and ask yourself, why are they doing that? So that's a big piece of this as well. Most people know life insurance is like be your own bank or NPI or IUL, common terms like that. And that's going to really, we'll talk about it all, but be careful when you're getting sold like this amazing philosophy behind life insurance. Life insurance has one purpose, guys. It's to protect your loved ones and dependents. It is a must for those with dependents. If you have a dependent of any sort, you need life insurance. I would say this applies to like 98% of people. Any adult, right? Obviously as a kid, it's a whole different situation. But if you're an adult, you have a spouse, you have kids, you have people relying on you, aka dependents, you need to have life insurance in place. This is not something you can take lightly. This is something if you aren't sure 100% of exactly how much you need, and not some crappy group universal life through work, and actual real enough life insurance, you need to listen to this tonight, guys, because this is your family that's relying on this in case you were to pass, okay? So a general rule of thumb across the board, and this is general rule because everyone's situation is different, everyone's life needs are different, 10 to 12x your salary, okay? So I'm going to make sure you guys can see the example over to the right. Okay, yes, you can see it. So let's say there's a spouse, right? You have a mom and a dad, and you guys they have two kids or whatever, and so one of those spouses is making $100,000. Another spouse is making $80,000, okay? So you have to multiply 10 to 12x each one of those salaries, so $1 to $1.2 million, and the 80,000 times 10 times 12 is $800,000 to $960,000. Your goal is to have coverage, as a rule of thumb, in that ballpark arena, right? There's no perfect science, again, but the reason why is because when you were to pass, unfortunately, if you were to pass, right, the goal of this income or this money, this payout that you receive from a life insurance company is going to not just go to your bank and just sit there. It's really to replace your spouse's income. So this money is going to go into like a brokerage account. This is going to be invested in the interest off of that. Let's say you're earning 8% or something per year. In an ideal world, that income is going to be replacing your spouse's salary. So if you were to have a job, you have two kids on the hook, and your bills are let's just say, after tax you're making 75 here, and after tax you're making like 60 here, and your bills are 110 to kind of maintain your lifestyle of what you're trying to do. The remaining is kind of invested right now in the situation. If one of those spouses were to pass, you would not have enough money to live. So you would have to ask yourself, how are you going to do it? You're going to either basically eat rice and beans and live in downsize and change your lifestyle, or you can have a cheap life insurance policy in place that can take care of that remaining income that you lost with a spouse. Granted, that happens, right? None of us expect this to happen. None of us want it to happen. Quite frankly, all of those types of things are horrific, but they can happen, unfortunately. I had a client in particular that had a pretty good salary, but she did not have enough to live off her own income, right? She had 3 boys, and they were all like teenage years or whatever, and her husband unfortunately passed, and she did not have enough money to cover that, so her boys had to go to work to cover their lifestyle. You don't want to be put in a position like that, guys. It's not worth it. A life insurance policy, and we'll get into the pricing and the cost of this, is really pretty cheap. We're talking, I'm paying right now for me and my wife, we pay $81 per month for $1 million in coverage. And on top of that, we get a 50% rebate every single year. So I'm a CPA, so I have it through the AICPA, which is Aon Insurance, really, and they give us a great rate as a CPA and stuff like that. But we get a 50% rate. So basically 81 turns to about $40 a month on average throughout the whole year once we get the rebate. And it averages out. So we're talking, my wife and I pay $40 a month, 40, to have $1 million in coverage on both of us equally in case something were to happen to one of us. It's unbeatable, right? It's something you cannot skate by, or it's too expensive type deal. You have to get this life insurance, okay? Now we have a term policy, so this is a lot. There's a lot to this, right? There's a tons of stuff all over the place. I would highly recommend to work with a broker. This is very, very important. In fact, for all insurances for the most part, right? A broker is going to shop the lowest rates amongst everybody, right? They're going to go out to the insurance community and they're going to say, okay, here's a rate here, here's a quote here, quote, quote, quote. Here are your options. Here are the most reasonable priced options for you. Now you get to select which one you're going to go to. If you want to work with a broker, you could go to someone local, or you could go to a bigger name and just Google, insurance broker nationally. So one of the big ones that's very popular is Zander Insurance, Policy Genius. I have one in particular that you guys could go through as well, Peacock Agency. So there's a bunch of different brokers, but ultimately what they're trying to do is go search the lowest rates. Okay? If a financial advisor, or they term themselves a financial advisor or salesman of some sort, is coming to you and selling you a life insurance policy, you better believe it's not a term life policy. It's a permanent life policy, and they are going for the commission, not your well-being. I can promise you that right now. People might have some might have your best interest at mind, but I can tell you right now, any financial advisor selling life insurance is probably making a fat commission. So you need to be careful if they're selling you something like a whole life policy or like an IUL maybe of something like that. They come very hefty on the commission side, and we'll get into the details of that in a second. But for the most part, I think 99% of you guys listening can probably just tune out and say, all right, I'm good to go. I need to term my policy. I need 10 to 12x my salary, and I need to make sure my spouse and myself have this. We're good to go. That takes care of everything tonight. That's really what you guys need to know. That's like the nutshell, the nuts and bolts of this. And if you're really signed up for this, you're good to go. I don't think the rest of the presentation is that important, but I do want to give the other side of the equation the light of day because I think it's important for educational purposes. But let's break it down, guys. So we have one other thing real quick, and I want to make sure you can see this at the top left. So I'm going to move this slightly to that. So see up at the top right, it says tip, lock in premium young. Let me explain a little bit about that before we go on. So when I say lock in the premium, what I mean by that is you are buying a term, let's say you buy a term life policy, right? This is for a specific time period. This might be 1 year, it might be 5 years, it might be 10 years, 20 years, 30 years. You are going to come to the conclusion you need X amount of years. Most young people in their 20s and 30s are going to get like a 20, 30-year policy. I, in particular, have a 1-year policy that renews every year because I'm through the AICPA. Mine's a little different, but in general, 20 to 30-year policy is pretty solid. If you are young, you're healthy, you don't smoke, you don't have any health issues or anything like that, you can get like a 20 to 30-year policy and you'll be set up for good, right? You will lock in that premium very young at a very cheap price. The premium increases every single year. So the point of the tip is saying, hey, what if I'm 25? I have a really serious girlfriend, maybe I have a fiance, but I don't really have a dependent, I don't really have a family yet. It might make sense in some scenarios to lock in your premium for a really, really cheap life insurance policy at the age of like 25 or 27 or something like that before you actually have a full family. Now, I wouldn't do this if I'm like 20 years old and have zero clue, like I don't have a girlfriend, I don't have a family, maybe I don't even plan on it, I have zero clue what's happening. I wouldn't do it at that point in time. But if you're like pretty serious with a girl or a guy and you might have a kid, you're expecting to have kids or that's the plan in the next couple years, it could make sense to lock in a premium just because when that comes around, it's going to be more expensive to get a premium, at 35 or 37 than it would be at 28 years old. So consider that as well. You could lock in a really cheap term life policy for something like, $20 or something like that at a very young age. I think I want to say I paid $20 a month when I was 27 years old or so, 26 years old. And I think I had $500,000 in coverage at that point in time. We didn't have much on the books. We didn't have kids or anything. It was just Aaron and I. We had like a paid off house. We had no debt. So we didn't need a bunch of, we didn't use the 10 to 12X obviously at that point. We just used like common sense and figured, hey, if I were to pass, how much do you actually need to kind of sustain your lifestyle? And we figured $500K was good at that point in time. I paid $20. She paid $19. So that might make sense in your situation, guys. So now we have the two questions. We have permanent and term, okay? So the difference in general is Term is for a specific time period, 1, 5, 10, 20, 25, 30, or whatever. Permanent's for your entire life. So some people might be like, oh, well, I would rather have it for my entire life than just a specific time, right? Maybe. It depends. Term is mostly for everyone. I would say this is meant for about 99% of people listening, hence why I said you could stop listening at this point in time. Permanent life insurance is about for 1% of people. It is sold to 100% of people, and it's a BS product for the most part. It's not the product itself. The product is the product. The marketing tactics behind this is actually extremely predatory for the most part, and you have to be very careful of who's selling you this. It might make sense for the 1% of people that are already wealthy, not somebody with a $200,000 net worth and not even maxed out an IRA, who they're marketed to. They're dealing with estate planning, which most people they're marketing to don't even know what estate planning is or have any idea, or they're trying to shield extreme taxes, which for the vast majority, they think they're doing a good job by shielding their taxes, but in reality, it's costing them an arm and a leg. And so, for example, like IRA and 401k could be double taxed, right? You could have an income tax and an estate tax. Now, most people aren't aware of like the estate planning piece of this, and that's why it's marketed as like the wealthy do it or the ultra wealthy do it, or I get it commonly talked about as the Rockefellers do it. Why wouldn't I do it? If billionaires do it, I should do it. Well, maybe you're not a billionaire and you don't need it unless you're a billionaire. That might make more sense. So permanent life insurance, guys, it is an option. It's not for a lot of people, but if you are wealthy, if you're figuring out estate planning and you're trying to shield taxes, it could absolutely make sense. It's a product. It's not a scam at all. Just as a 401k is not a scam to the young kids. But the problem with this is it's marketed the wrong way. People say be your own bank, like I say, infinite banking concept, all these types of like little buzzy term words or whatever, like I want to get rich before 60 type deal. That's pushed, and in fact, it's not an investment. It's not. Yes, you can invest a portion of your money within some of these policies, but it is not a good investment. It is not allowed to be marketed as whole life cannot be actually marketed as an investment because there's benefits to it. Like I said, for people trying to shield taxes, but from an investment standpoint, there's way better alternatives. You aren't using a policy like this really from an investment standpoint. It's more so for estate planning to avoid tax or to enhance your wealth long term and shield taxes. So you have to. That's a very, very important distinction between how it's marketed and really what the benefits are. Okay, so with a permanent life policy, guys, you have universal life, right? You have term life over here, then permanent, right? But this branches off. This branches into universal life. That branches off into guaranteed universal life, index universal life. IULs are typically the things that are sold to the average, American, and then variable universal life. So those are three options off universal life as well. You have whole life policy and you have variable life policy. Okay? I want to talk in particular about term life, which we've already done. I want to kind of expand upon whole life, and I also want to talk about IULs because I feel like for the sake of this presentation, these are what's marketed the most is whole life and IUL, and I want to make sure you guys are fully aware of what that truly means. All right, so let's see if I can make sure you guys can see this a little better over here on the far left. Okay, so up here, guys, we're going to start with term life, a little more detailed than just this right here. So term life is cheap, like I said, 5 to 15 times less costly than all of these below. That is an extremely important piece of this. So no matter what your insurance agent tells you or your financial advisor, 5 to 15 times less in cost. It makes sense for 99% of the people. You can define your period. So the green's the benefit, obviously the red's the con, sorry, for clarification. You can define your specific period. So you don't have to have a policy for your whole life. You don't have to pay a premium for your whole life. You say, okay, I need it for 10 years. I need it for 15 years. I need it for 25 years. I need it for 30 years. And you get to decide that. So you choose how long you pay that premium. The downside is it does expire. So the way you look at that is saying, well, if I were to pass at, let's say, a later date and time and I don't have term life, you know what? My family better be self-insured. And so what does the self-insured piece mean, right? Self-insured is simply when you have enough assets, if you were to pass, that your family's okay. Let's say you have $1 million in assets, and those can be liquid, actual liquid assets your family can use to their benefit of their wealth. You're probably self-insured. You probably don't need it any longer, which is why defining that period is really important, because if you set yourself up at a young age for a long time, you don't need life insurance at the age of 65 or whatever, or 70. Again, if you are ultra wealthy and you are estate planning, it might make sense to have a whole life IUL or something along the lines of a permanent life policy for other reasons than the investment component. We have whole life, okay? Whole life is the benefits, right? You have it lifelong. There's a cash value portion of this, right? This is a living benefit that you can have, okay? So the cash value portion is what people get or all excited about. And they're like, oh my God, cash value, it's a forced savings or whatever they say. Just automate your savings if that's the benefit they're selling you. It's forced or whatever. The problem with this though is the cost. It's 5 to 15 times more in the complexity. There's fees, there's taxes, there's interest, there's stipulations. You have to be very, very cognizant of what those are and how the net benefit of what you're trying to use this for is really amounting to. Because if you just kind of blindly go with the guy that says, hey, this is a great policy, you can get tax-free distributions and borrow against your policy and all this kind of crap, make sure you understand everything involved, and the fees, taxes, interest, and stipulations are significant to that picture. All right, so that's whole life. Universal life, IUL in particular, right? This has the cash value component. The problem with this is the investment cap. There is a minimum and maximum. So what this does, what this piece is when you put money into this, it goes into this index that's mirroring the index, right? And you have a minimum, which is typically 0%, and a maximum, which could be 12 to 15% on average, depending on the policy you have. So if the market's below, if it loses a bunch of money, this is where a lot of insurance agents will not scam you, but they'll sell you on this piece of it, is saying, if the market's down like it is now at 20%, you lose 0. But if the market's up, you don't get the benefit. And so natural, human nature will say on a conservative basis, that sounds pretty good. I might not get the highest, but I definitely won't lose anything. And they get suckered into it, right? The problem is, if you guys have followed me for investment advice at any point in time, 2 things are wrong with this. You're paying a fee to invest money when you could just have an alternative. You could use term life and invest the rest anyway. That's the first thing wrong with this. Secondly, if you are not taking advantage of all of the market, then you're missing out on the market. When the market drops, you want to be buying. You don't want to be running away from net volatility. Volatility and wealth building, they're best friends if you do it right. You have to be set up the right way to figure that out and maximize that. 3 things that you want to be aware of this, right? The participation rate. Participation rate is very key, guys. So if in your contract it says 80% participation rate, if the market gets a 10% return, you only get 80% of that in 8% return. That's very important. So participation rate is something you want to pay attention to. The cap on gains, like kind of what I was just talking about. If the market goes to 20%, but you have a 10% return because that's the cap on your max rate that you can receive, or 12% or 15%, you are missing out on significant gains in the market. That could hamper your wealth long term. You also aren't able to buy at lower prices because you're locked into that 0 minimum or whatever right there. The other thing is the death benefit and the flexible premium aspect of this. You want to be aware of this. The policy can lapse if there aren't payments being made. The cash value component, if let's say a payment's not made, there's some contracts that have the cash value kind of cover that, and it's kind of subtracted from that. So I wouldn't get to that point if I was trying to figure this out or use this vehicle. I would just pay what I owe. But that's also a downfall, or also something that can happen as well. Okay, so the last piece, guys, is variable life right here. Index universal life. Who is this for? Remember, term life's for everyone. This is for, you've maxed out all other accounts, retirement accounts, that is, 401k, IRA, and stuff like that. the reason I think it's not only maxed out all the other accounts, you've taken advantage of like a brokerage account on top, which has no maximum amount. And so there's a lot of benefit of just putting in a term life policy, spending way less, taking this difference and putting it into a brokerage. That's typically a way better option. But if you max out all the other accounts, you want a relatively safe min-max kind of type of deal. This could make sense for that individual, for an IUL. But don't get caught up in all the jargon they try to use to sell you. Variable life, okay? So this is put into mutual fund sub accounts. The benefits of this would be the savings potential, obviously. But again, I don't know if that's necessarily a benefit because you could save elsewhere. As long as you kind of fix those automate those saved payments, you're good. And the ability to borrow against, which is oftentimes times broadcasted to the general public. You can borrow against this, all this kind of stuff. The cash value and death benefit can flux, variable, hence the name, right? So you want to be careful with that. And then also high fees are significant, along with all permanent life policies for the most part. There are a lot of fees. So if you take a step back and think, okay, after this, I've kind of gotten through everything. Obviously, you guys can see I'm a little biased. And when I say biased, I'm not biased. I'm aggravated that these products are marketed to the wrong people. Because there is a legitimate reasoning for some of these products in some people's position. The problem is they're marketed to the wrong people. It's unethical. It's snake oil salesman. It's car salesman type deal, and it's just not right. So that's why I'm a little down on these things. But again, they have the benefits, they have the cons. If you're aware of those, if you're already wealthy, if you're estate planning, if you show it in taxes, okay, that's fine. If you don't have over $1 million net worth, don't touch this stuff. There's no benefit to it. And I'm sure there's some comments debating that. I'll get to those in a second. The other piece of this, guys, is common sense, right? We are going back to the basics here, and I'm going to scoot this back over a little bit. We are going back to the very, very beginning. It's a must for those with dependents. What's the point of life insurance? If you pass away, your dependents are taken care of. So the complexity within a permanent life policy doesn't always make sense when a term life policy is extremely simplistic, and simplicity typically wins, okay? If you have the coverage, you're paying way less, 5 to 15 times less than the average policy, and your family's covered, you're probably good. Take the extra money and invest it into a brokerage. Now, humans don't have the discipline to take the difference and invest. Everyone wants to argue, pay the lowest minimum on your debt and invest the rest, right? That's not the reality. That's not how life works. If it was that easy, we would all be billionaires and we'd all, maximize the math and all that kind of stuff. The reality is, people are going to take that extra money, things are going to pop up, that money is going to go out the door for different reasons, and they're not actually going to invest that. The key is automate your investments, and which is why I always typically say automate. It's such an easy thing to do, but people don't realize how important it is. Just like most things in the world, the easiest things are people just don't take advantage of it, and they don't do it consistently. But if you do it consistently, you automate your savings, the 5 to 15 less that you're spending, and you put that into a brokerage account, and you have a term life policy, you should be good to go. Your family's set up, you've locked in a cheap premium for years to come, and by the time that policy runs out, that term life, you're probably self-insured because you know what you're doing with the money because you follow the budget dog, right? And you're set up. So that's really the gist, guys, of life insurance. This could be a longer conversation, obviously, but I wanted to hit on the high-level bullet points that are very important to know when you guys are out there. We could obviously go further into guaranteed universal, variable universal, all that kind of stuff. There's really not much of a benefit to do that in this presentation, guys. And I'm going to answer some questions now. So let me flip my thing around, and I will get to all the questions that you guys have when it comes to life insurance. All right, so I'm going to start at the top, guys. I'm just going to scroll to the very, very top and begin there. So hopefully that was good, a little breakdown of life insurance in general, and just made it very clear as to kind of all the stuff you're going to see in the DMs and stuff like that. Let's see. Is it true that term life insurance will give you your money at the end of the term if you have not passed? No, you have to pass to get the death benefit. Fat commission. Yes, they get a fat commission. And guys, it's pretty obvious. It should be common sense, but it's not. If your college roommate is hyping you up on some policy, typically that's where it comes, is college roommates, old friends, because what they do is they go contact their most closest people and they say, hey guys, this is a great policy. I know somebody that was paying, think 5 to 15x, right? If I'm paying $80 for a combined couple, $40 for my wife, $41 for me, I divide that by 2 technically because I get that rebate, like I said. One of the policies I looked at, one of my clients, they were paying like $500-$600 per month for this stuff, for the whole life policy. I think they had an IUL or something like that. But it's crazy how much you're going to pay an extra when you can literally just get term life and invest the rest for the most part. Unless you guys are already wealthy, not becoming wealthy. You are estate planning. You're trying to avoid shielding, and you're trying to shield taxes. Because there's a lot of strategies, guys, to use an insurance policy or an annuity when you're ultra wealthy to up the benefit. Transferring from like 401ks to IRAs to like basically different types of products, and it makes sense in like a very, very small subset of people. And when you're seeing online like the internet gurus of Instagram and Twitter and stuff like that, not actual professionals with designations behind their names, they're going to sell you that for the reason of commission. That's just the reality of it. Is Uncommon Yo going to jump on the debate in term versus IUL? Actually, Tommy, so Uncommon Yo, guys, he does have a whole life policy, but he uses it for different reasons, right? There's actually legitimate reasons that he uses it, and he often mentions this is not an investment. This is not for me to use as an investment. He's very open about it and very well educated on the topic, and I watch his stuff a lot. So he would not debate me when I of what I said tonight. He might debate like whether you should use it or not, but as far as like the investment component that you're sold on, they won't. That's what they said to me, George. I'm telling you, man, that's what they all say. I know the shady game. There's a lot of financial advisors in my circle that I've come across that will say something along the lines of, the investment component or the cash value or the living benefit or the tax-free, all that kind of stuff happens all the time. I was in the business, guys, for a long time as a CPA. So I ran across a lot of people in similar industries, insurance, CFA, CFPs, stuff like that, where the lingo and the jargon that's used is very, very similar to what I see online, and sad. Is this term life? Yeah, term life and permanent life. My dad recently got pitched whole life and is worried about the market and likes the pitch about covering healthcare costs during retirement. How do I best explain how this is a bad idea? And I don't know the situation, obviously. For health costs in particular, obviously healthcare costs, we've done a presentation at Whiteboard Wednesday on HSAs. HSAs, FSAs, brokerage accounts, retirement accounts to plan for healthcare costs in the future is what you should be doing. Also, on top of that, you should be having a long-term care policy in place, especially if he's older and getting close to that retirement age. A long-term care policy would make a lot of sense, likely. Different types of insurance, good medical insurance, obviously, is a no-brainer. But having the proper insurances in place on top of this, along with the other investments to plan for the upcoming future, is super important. But don't get sold on the backdoor way of kind of taking care of that. Thank you very much, by the way. Appreciate you, George. Thanks, man. If you outlive term, can you increase the term again? Say you can get 20 years and can you increase it another 10? So there's something called like a conversion rider. I've actually learned this kind of recently. And so the conversion rider, I believe, is an extra cost to the policy when you first sign up, but it gives you flexibility in the future to make tweaks to it Every policy is extremely different, so I would make sure you confirm that you're able to do that. Most term life policies, if it's a level term life, it's just going to be a straight shooter of whatever amount of years, unless you add additional clauses to the contract. One of the realists in the game. Appreciate you, boy Brett. Appreciate you guys. Thank you so much. How long would you suggest to get a term life policy for? However long you personally need it, right, guys? So again, until you're self-insured, so until you have enough assets and you can predict your assets based on your investment returns and your investment contributions, right? It's the similar compound interest type deal. So that is very important to kind of plan out. And obviously life doesn't work to a spreadsheet, but at least have an idea, hey, I'm going to be financially free when I'm 55 or when I'm 60 years old or when I'm 65. Your policy should ideally coincide with that exact date. Okay guys, this is what I'm talking about. I joined late, but I keep hearing get a whole life policy and use it like a bank. Be your own bank. Infinite banking. Please do not fall for that little stuff, guys. But I'm glad you said that, because that's what I've been saying the whole night. There's a lot to it, guys. What's bad about the group policy? Good question. Okay, so the group term life, guys, is typically through work. So something I left out in this presentation tonight so far was the group term life through your work. So oftentimes your work will give you 1 to maybe 2x your salary in life insurance. Like I said, based on this rule of thumb, 10 to 12x is kind of what you should do. Now, everyone's situation is different, but 1 to 2x is probably not going to cut it, right? So if let's say you make $100,000 in this same example up here, and you were to pass, and your spouse is making $80,000 a year, you get $100,000 or 1 extra salary, your spouse does, and she tries to invest that, or he tries to invest that. That is not going to do the make up for the difference. And so group term life is cheap. It's through work, and most people just maybe default into it. I'm not saying don't have it, but make sure you prepare over and beyond that. Also, if you get fired from your job or you leave your job, you will be in a spot where until your next job that may or may not have it, you won't be covered. So don't get in the position where you get fired, you get let go, something bad happens in the market and you get let go, right? And you aren't covered and the unfortunate happens. You don't want to be in a position like that. So yeah, the downside, you aren't covered after you leave the job, and the downside of usually it's not enough coverage in general. But it's not like a bad policy itself. Like there's nothing wrong with the actual policy. It's still a form of term life insurance. Just like think of when a big company goes to buy a big bulk package so they get a better discount. Using hybrid life insurance for the long-term care rider. Yeah, long-term care rider, that's what it is. Versus long-term care insurance, thoughts. You'd have to price it out for sure. So it depends when you get it, how much that long-term care rider is for that conversion in the future potentially. It's really a math equation, honestly. You'd have to say what's typical long-term care insurance right now. If I was 60 years old, what's this over the course of life? What's the conversion aspect of it? And then just do the math and figure out what makes most sense. I haven't done that math, or I would have a very precise answer. My goal is long-term care insurance in general, though. I do think long-term care rider is typically less beneficial from my understanding, but I don't want to speak on that because I'm not an expert on long-term care rider in particular. So it sounds like a few of you guys have the conversion rider. Try to get me to do a conversion TR. I think a rider, maybe you mean by that. Yeah. I got a quote and it went way up after I told him of temporary medication I was on and was told to try again next year. Should I wait or get quotes from other companies? Yes. So medications, guys, are going to, there's some quotes, guys, or some term life that won't require a medical exam. I'm not saying to lie on the thing, but some of them don't actually check. Take that information and run with it. But if they did audit you or check you, and you had prescriptions, or they do a background check or whatever, that it pops up, you would obviously get denied. But I know a lot of insurance companies for $1,500,000 or whatever, they don't require any medical examination or anything like that. And they wanted crazy monthly premiums because I only have 12 years left on my term. But instead, $20, it would change to $150 for an extra 10 years. Okay, gotcha. Wow, so $130 extra on that. Plus $130 plus the actual conversion writer cost as well. That's insane. I'd be upset. Yeah, I'd be upset too, guys. I'm oftentimes upset when I see people selling crap products to people that shouldn't be marketed. If anybody's ever came in my DMs and they'll say, hey, I'm looking to help with budget, I know the product I have for you. But if someone comes to me and says, hey man, I am looking to start in real estate, I'm not a real estate expert by any means. I'm going to say, I'm not the guy. Here's the guy that probably helps you, and I have a good referral network that I know would like actually legitimately help somebody. But like, I'm never going to market something, even my academy calls. If I have a call and I don't think they're a good fit, I'm going to tell them straight to their face, hey, I don't think this is a good fit. You're looking for something that this does not offer. And so I'm going to be very, very transparent with what I sell and what I have versus saying, you know what, this probably makes sense for you because I'm going to take your money. Like, that's so wrong on every single level. But unfortunately, the insurance industry is known for that. Now, there's a lot of good people in the insurance industry. This isn't to bash the insurance industry. But the reason it has a reputation like this is because there's a lot of it going on. And so you do have to steer clear of unethical characters in the insurance industry or the financial advisors that are selling insurance as well. If you work with Northwestern Mutual, be very careful with Northwestern Mutual. They typically will get you in the door with insurance and then latch onto your assets. Any big insurance company, guys, for the most part, or any big financial institution, what they often will do is like get your business in the door, and then they'll eventually upsell you to different products. That's kind of the model they use. So you have to be careful when they're bringing you in with something else and then they kind of sell you because you're a long-term client. You get client long-term rates. They make you feel special type deal. So be very careful with that as well. The marketing game is a scary game, guys, if you really know what people do with that. So I'm not a teacher. I'm a CPA. My mom's a teacher. She just retired. I chose not to do the conversion. It wasn't worth it. Yeah, makes sense for sure. Any life insurance companies you suggest to work for or like work with, like trying to get a policy through? I think, so Aon Insurance is who I'm through and I feel very good with them. I'm a CPA, so I go through AICPA, which is Aon Insurance. I feel very comfortable with them. The brokers, like I said, Policy Genius is legitimate. Zander Insurance, Zander, Dave Ramsey backed, very legitimate. I actually just ran policies the other night. I was just trying to do some math. And of course, I got hit up with like 1 million texts and emails and calls and stuff asking for to finalize that. I was really just running quotes to get some quotes. But yeah, they'll hound you. If you run some quotes, guys, you'll get hounded. You'll walk away with lots of life insurance policies with Northwestern Mutual. Yes. Be very careful with them. I'm an agent, so who to work for. Gotcha, man. Honestly, like outside of the names I listed and who I've worked with before, there's really like no one. I'm not like hating on any insurance company in particular. I don't think there's like anybody like that like raises a red flag. I just think you got to understand the education behind it and like what you're selling and making sure what you're selling makes sense for the individual. If I was selling term life insurance, I would sell you term life insurance every single day. I don't sell term life insurance. If I did, I would have no problem harassing you and your family to get term life insurance because it's good for you and it makes sense. And like I said, if you have a dependent, you need term life insurance. But I would never sell 99% of people an IUL or whole life policy or something like that because it just doesn't fit the mold for what or the product doesn't fit the need. AAA life insurance, I think they're fine for the most part from what I've heard. Again, guys, I'm not like an insurance company expert, so I don't want to like speak out of context or like speak out of line for sure because I don't really truly know that. I haven't like broken down each company. I will say if Primerica, watch out for Primerica. some dogs right there. 28 years old, $30 a month, 30-year, $500,000 policy. Pretty solid. Yes, exactly, guys. A 30-year policy, 28 to 58 years old, $30 a month is all they're paying. Georgia's paying $30 a month for a $500,000 policy. So super cheap, right? I'm trying to think. I'm 30 years old, and I pay like I said, $41 a month, but I get the rebate. So you divide that in two, and I'm roughly like $21 or whatever, $20.50 or whatever. But it's year to year, so that goes up. So it probably averages out to about that. But I also have $1 million policy. It's a lot of comparables. How do you get half cost reimbursed? Sorry. My AICPA, so I'm a CPA guy. So within the AICPA, and you get a benefit as the CPA. Because first off, I pay into the AICPA $315 a year. So that's to get like CPE and continuing education, stuff like that. So that's just a benefit you get within the group. Like I get benefits on like other insurance as well, like car insurance and things of that nature. So there's a lot of benefits, I guess you could say, through the AICPA. Especially for like CED and education and stuff like that. So, but then you have to think I've actually done this before, is like, I've looked elsewhere for term life and policies as well. And I looked at, okay, well, AICPA and insurance is way cheaper, but I also pay $315 a year. So if I annualize or take that and divide it by 12, and I get a monthly cost and tack it onto the benefit I get, what's the actual overall benefit is what I typically look at. But then you got to factor in like the other benefits I get with like the continuing education, which I have to pay for, and make sure I have hours to stay a CPA and stuff like that throughout the entire year, or I can be inactive and I have to pay a fee basically to get that back, which I don't want to do. So husband and wife with no kids, insurance needed? Yes. Dependent. So wife or you pass away, one of you guys need income, so definitely get insurance. Those guys are sharks, yes. Be careful. Primerica, guys, is bad. So Primerica tried to recruit me because it's an MLM for the most part. And there's good people in all MLMs, but very few make, it's not an MLM really, but you get a cut to, it kind of is an MLM. And if you look at like the actual statistics of an actual MLM, like an Amway or something like that, like less than 1% of people actually make money. The other 99% are losing money, but they're selling the services or selling the products or selling membership to be within, under the branch or tree of the whole crew. So there are a very small amount of people that make money in those types of businesses, and it's get rich quick type of feel. I feel like, I don't know, that's kind of how I've been approached by it. It's like, hey man, you can come onto our on Primerica and you can like get a bunch of clients and you have 120,000 followers. Like you could basically go get a ton of business. I'm like, yeah, but that's unethical and that's like not a good